Are you just dipping your toes into the world of investing and feeling a bit lost in the sea of options? Trust me, you're not alone, and it's perfectly normal to feel a bit overwhelmed. I'm about to take you on a journey through very simple steps for constructing a powerhouse dividend portfolio. And hey, I will be sharing valuable insights which you might want to apply them to your own investing adventure to increase your wealth. Starting from an expert in the field, Warren Buffett, who is a maestro in the world of investing, shared a timeless piece of financial wisdom. Do not save what's left after spending. Instead, spend what's left after saving. It's a philosophy that resonates with the essence of growing wealth. And speaking of growing wealth, what could be a better way than constructing a robust dividend portfolio? Dividends have been a central topic in financial circles, and now there is a buzz around monster portfolios, ones that offer both safety and high dividend. In this video, we are about to embark on an enlightening journey, guiding you and John through the art of creating a monster dividend portfolio. We will explore what factors to consider when choosing an investment company, how to structure your portfolio effectively, and the common pitfalls to avoid. Our aim is to provide a step-by-step guide revealing the secrets of crafting a potent investment plan. This plan not only ensures a steady stream of income, but also holds the potential to catapult your wealth to unprecedented heights. Whether you are a seasoned investor with years of experience under your belt, or just taking your first steps into the world of investments, get ready for a transformative journey. We are here to share the strategies, tips, and tricks that can supercharge your ordinary portfolio into an unstoppable force in the realm of dividends. And it all starts with the basics, so let's kick things off by delving into the fundamentals. Dividends represent a slice of company's earnings that are shared with its shareholders. When you invest in a company's stock and become a shareholder, you essentially become a partial owner of that company. As a result, you become entitled to a portion of the profits that company generates. When a company turns a profit, it has the option to divide up some of those earnings among the folks who own its stock. So, if you are a shareholder in a company, you are in for a potential bonus, a share of its earnings in the form of dividends. It's like a little extra reward for having faith in the company and being part of its success story. Sure thing, here's the info in a more original and straightforward way. You will often see the dividend amount expressed as a percentage of the stock's price, which is called the dividend yield. Now, when it comes to the timing of these dividends, it can vary. Some companies are quite predictable, handing out dividends on a regular schedule, like clockwork. It's a bit like getting your paycheck every month. You can rely on it. Some companies like to surprise their shareholders with something extra. These are special dividends, and they pop up when a company is in exceptionally good mood, typically after a very profitable period. To get a good grasp of how dividends operate, let's break it down with a straightforward example. Picture this. You own 100 shares of a company, and that company happens to pay out 50 cents for each of those shares every 3 months. So, what does that mean for you? Well, every 3 months, you will be receiving a sweet $50 as your reward for being a shareholder. If you are savvy and reinvest the dividend money to buy more shares, your investment has the potential to grow over time. It's like watching your money multiply right before your eyes. Now let's talk why investors love dividend-paying stocks. Well, there are a couple of compelling reasons. First and foremost, these dividend-paying stocks offer something that many investors adore: regular income, almost like clocking in for a monthly or yearly paycheck. It's the financial equivalent of having a steady job. Another reason is the comforting feeling of safety. Even though the stock market can be a bit of a roller coaster with its ups and downs, companies that dish out dividends tend to be like the sturdy oak tree in the financial forest, stable and profitable. It's like knowing you have a solid roof over your head during a storm. And here's the real kicker. The dividend approach may not be flawless, but it does a stellar job at one crucial thing. It gives us a fighting chance to beat the ever-sneaky inflation over time. It's like having the best of both worlds when you combine dividend-paying stocks with bonds. It's a dynamic duo that can keep your financial ship sailing smoothly. Warren Buffett, the guru of investing, once wisely remarked, "The investor who expects a safe 5% return without any risk is asking for the impossible." It's a bit like hoping for a magical insurance policy that covers you in every situation. A wishful dream that reality can grant. Even the old trick of stashing cash under the mattress won't cut it, thanks to the sneaky but persistent beast called inflation. In the world of investments, there is an unavoidable truth: risk is part of the game. In fact, it's like the price of admission. Why? Well, because the shadow of inflation looms large. It's like that nagging feeling that time is ticking away, eroding the value of your money. But here's the silver lining. Growth is your secret weapon. It's the ace up your sleeve, the one and only way to outsmart inflation. So, taking calculated risks become not just a choice, but a necessity to ensure your money doesn't simply languish, but has the opportunity to flourish. Now that we talked about basics, let's talk how to create a monster portfolio. Now that we've got a grip on the what, how, and why of dividends, let's move on to the first leg of our journey to craft your monster portfolio, selecting those dividend stocks. And here, we swear by a simple rule: safety first. It's a bit like the sage advice your mom gave you about looking both ways before crossing the street. The same principle applies to your investments. You see, the easiest time to steer clear of trouble in the world of investing is before you even take the plunge. So, here's the game plan. Set your criteria, do your homework on potential companies, and exercise a little patience. In fact, if you are ever in doubt, just take a step back and wait a bit longer. You'd be surprised how many woes have been sidestepped in the investing world by simply saying no, rather than diving headfirst into uncertain waters. And while you are in the waiting game, keep your eyes peeled for those true blue chip stocks with balance sheets so sturdy they might as well be made of titanium. Look for the ones that offer a juicy yield, say around 4 to 5%, or maybe even more. The idea is to aim for stability that's akin to have a rock-solid fortress. It's Gentleman's Finance channel, and if you found any value so far, please like and subscribe. Not every risk can be completely sidestepped, but here's the good news. You can definitely steer clear of the avoidable ones if you are picky about your investments. In this regard, let's take a shining example: the IBM, fondly known as Big Blue. These folks have an incredible track record of handing out dividends to their shareholders. In fact, they've been doing it consistently for a staggering 28 years in a row. Just let that sink in for a moment. Through thick and thin, they've managed to increase their dividend payout year after year, like clockwork. And here's the latest piece of evidence. In the year 2023, they upped the dividend once again, signaling that they've got the financial muscle to keep this impressive streak alive. Next is, of course, Microsoft. You've likely heard of them, and they go by the ticker symbol MSFT. What sets Microsoft apart is their remarkable track record when it comes to dividends. For a staggering 11 years in a row, they've been raising the bar, continually increasing their dividend. Microsoft is not just any dividend-paying company. They belong to an elite club known as the Dividend Achievers. To qualify for this club, you need to boost your dividend by a minimum of 10% every year for a solid decade. And guess what? Microsoft checks that box too. Now let's talk numbers for a moment. At first glance, their current dividend yield of 0.82% might not exactly set your heart racing, but when you step back and look at the grand scheme of things, it's a whole different story. Microsoft boasts an impressive 10-year dividend growth rate of 11.57%. This means that despite a seemingly modest current yield, we've been unwavering in consistently increasing their dividends over the past decade. So, for long-term investors on the hunt of steady income growth, Microsoft stands tall as a compelling choice. It's like investing in the tortoise in the race, slow and steady, but always moving forward. So, don't let those current numbers lead you astray. The truth is, the past often holds the key to understanding the future. In the case of Microsoft, their history of consistent dividend growth paints a promising picture. Let's shift our focus to another standout player, Broadcom. This tech powerhouse is a force to be reckoned with, specializing in computer chips and software. Their track record of consistently upping their dividends since 2010 is quite a feather in their cap, signaling a commitment to rewarding their investors. As of now, their dividend yield might not seem overly impressive, standing at 2.05%. However, don't let that number fool you. When we peer through the lens of growth, things start to get interesting. Broadcom boasts an outstanding 10-year dividend growth forecast of 37.71%. To put this into perspective, back in 2010, they were paying a mere 7 cents per share. Fast forward to today, and that number has skyrocketed to a substantial $16.9 per share. If this remarkable growth trajectory holds steady, there's every reason to believe that Broadcom could maintain this impressive 37.71% dividend growth rate a decade from now. Next, we will talk about Barnes & Noble. Well, Barnes & Noble might lure you in with a juicy 9.24% dividend yield, but don't be fooled. Their business is struggling due to Amazon's competition. They are paying out more in dividends than they are earning. Sales are going down, and there's a CEO lawsuit. Some folks want the company to sell out to Amazon or private equity firms. So, aim for companies that can steadily grow their dividends instead of just chasing a high starting yield. Those steady companies tend to treat investors better in the long term. Now, with your portfolio loaded with solid picks, consider what to do with your dividends. Remember, this is likely a long-term game, possibly for your retirement. If you are into dividend growth stocks, your smart move is to reinvest your dividend and give the magic of the dividend snowball effect time to work. This way, you can end up with a much bigger return on your investment compared to parking your money in a high-yield assets that don't offer much, if any, dividend growth. It's all about playing the long game, and the rewards can be pretty darn impressive. Now, let's talk about investing and reinvesting. Let's dig into the power of dividend reinvestment. Imagine you've picked out some solid companies for your portfolio, thinking long-term, maybe even retirement. If you've gone for dividend growth stocks, here's what you should do next. Reinvest your dividends and give the dividend snowball time to do its thing. The payoff can be much better compared to parking your cash in high-yield assets that aren't growing their dividends much, if at all. Want to see the difference in action? For example, if you start with $10,000 investment in a stock offering a 10% dividend yield. If you don't reinvest dividends over 1 year, you make $1,000 in dividends. Fast forward 30 years to your retirement, you still got that initial $10,000 earning you $1,000 a year. Now, here's where the magic happens. If you reinvest your dividends, that same $10,000 investment after 30 years turns into $193,581. It's paying you an annual dividend of $18,206 or $1,517 per month. That's a huge difference. In fact, reinvestment has added an extra $183,581 to your investment. That's the kind of magic you want working for you in the world of dividends. So, there you have it. From mastering the basics to constructing your monster portfolio, we've covered the journey. Now, it's time to put these insights into action. Since you learned how to build monster dividend portfolio, all you need is a little motivation to start taking action. And this video I made about how fast dividend investing can make you passive income can really help you imagine what can be achieved. Check it out. Before you leave, don't forget to like, share this video and subscribe to our channel. Your small effort will help us go a long way in creating such videos.